The U.S. stock market has experienced unprecedented volatility since the announcement of sweeping tariff increases by President Trump. As of April 8, 2025, futures indicated a potential rebound after a historic sell-off, with Dow futures up 1.69%, S&P 500 futures adding 1.11%, and NASDAQ 100 futures up 0.91% in pre-market trading. This modest recovery comes after the market lost trillions of dollars in value over the previous trading sessions. The dramatic market decline began when President Trump announced surprisingly high tariff rates on most key U.S. trading partners, with rates reaching over 100% in some cases. This triggered immediate concern among investors about the potential for a global trade war and its implications for economic growth, corporate profits, and inflation. The situation worsened when China announced retaliatory tariffs of 34% on all U.S. imports, setting the stage for escalating trade tensions. Reuters. Recent market performance. The past week has witnessed historic market movements. The Dow Jones Industrial Average experienced back-to-back losses exceeding 1,500 points for the first time in history, including a staggering 2,231-point decline on Friday. The S&P 500 plummeted 6% on Friday alone, its worst single-day performance since March 2020 during the pandemic outbreak. Over just 2 days, the index lost 10%, pushing it more than 17% below its February record high and dangerously close to bear market territory, a 20% decline. The Nasdaq Composite has already entered a bear market, down 22% from its recent record after consecutive daily losses of nearly 6% on Thursday and Friday. Market volatility has reached extreme levels, with the CBOE Volatility Index, VIX, often referred to as Wall Street's fear gauge, surging above 60 on Monday, levels not seen since August 2020. The VIX has since moderated to around 44.1 points but remains significantly elevated compared to historical averages. CNBC. Technology sector impact. The technology sector, which has led market gains in recent years, has been particularly hard hit by the tariff announcements due to its global supply chains and significant exposure to international markets. Major tech companies have experienced significant declines. Apple has been severely impacted, dropping almost 4% on Monday alone, reflecting investor concerns about its heavy reliance on manufacturing in China. Microsoft and Tesla have also posted substantial losses. The picture is mixed for other tech giants, with Alphabet, Amazon, Meta, and Nvidia showing more resilience and posting modest gains in the most recent session. The cumulative impact on tech stocks has been substantial, with most showing double-digit percentage losses since the beginning of April. Federal Reserve outlook and interest rates. The market turmoil has dramatically shifted expectations for Federal Reserve policy. Prior to the tariff announcements, the Fed had maintained a relatively cautious approach to interest rate cuts, keeping the federal funds rate at 4.25% to 4.5% during its March 2025 meeting. Federal Reserve interest rate projections, 2025 to 2026. The market is now pricing in a much more aggressive easing cycle. Traders now see more than 96 basis points of easing by December, implying 3 fully priced 25 basis point cuts and an 84% chance of a fourth reduction. This represents a significant shift from the Fed's previous projection of just 2 rate cuts for 2025. The Fed now faces a complex dilemma. While the growth outlook has deteriorated due to trade concerns, the risk of higher inflation from tariffs has simultaneously increased. This stagflationary scenario, slowing growth with rising inflation, complicates monetary policy decisions, as rate cuts to stimulate growth could exacerbate inflationary pressures. Reuters. Economic impact of tariffs. The announced tariffs are expected to have far-reaching implications for the U.S. economy, with varying impacts across different scenarios. Impact of tariffs on inflation and GDP growth under different scenarios. Key economic concerns include inflation risk. Tariffs typically function as a tax on consumers, as importers and producers pass increased costs along the supply chain. This could lead to higher consumer prices at a time when inflation had been moderating. Growth impact. Higher tariffs risk disrupting global supply chains, reducing trade volumes, and dampening business confidence, all of which could weigh on economic growth. Some economists are already revising their GDP forecasts downward for 2025 to 2026. Wealth effect. The massive decline in stock market valuations could create a negative wealth effect, potentially leading consumers to reduce spending. As noted by Ed Yardeni, president of Yardeni Research, the plunge in stock prices increases the odds that the resulting negative wealth effect will depress consumer spending, which increases the odds of a recession. CNBC. Future market scenarios. Looking ahead, several scenarios could unfold, with varying implications for market performance. S&P 500 Future Scenarios Projection. Scenario 1. Trade negotiations succeed. If the U.S. and key trading partners reach agreements to moderate the proposed tariff increases, markets could see a significant relief rally. More than 50 countries have reportedly approached the administration to begin negotiations, suggesting potential for diplomatic solutions. Under this scenario, the S&P 500 could recover much of its recent losses and resume its upward trajectory. Scenario 2. Partial tariff implementation. In this middle ground scenario, some tariffs would be implemented while others might be scaled back following negotiations. Market volatility would likely persist, but at lower levels than currently experienced. The S&P 500 might trade in a range, with sector rotation based on relative vulnerability to tariffs. Scenario 3. Full tariff implementation and escalation. The most bearish scenario would involve full implementation of announced tariffs and continued escalation of retaliatory measures by trading partners. This could trigger a global trade war with severe economic consequences. Under this scenario, the S&P 500 could enter a prolonged bear market, with the potential to test support levels around 4,700, representing a further 7 to 8% decline from current levels. Investopedia. Sector outlook. Different sectors will be impacted to varying degrees based on their exposure to international trade and tariffs. 1. Technology. As outlined earlier, tech companies with global supply chains face significant headwinds. However, companies focused primarily on software or domestic services may show greater resilience. Tech sector outlook under different trade scenarios. 2. Healthcare. The healthcare sector, particularly companies with less international exposure, may outperform in this environment as investors seek defensive positions. 3. Financials. Financial institutions face mixed prospects. Higher volatility can benefit trading revenues, but economic uncertainty and the potential for accelerated rate cuts could pressure net interest margins. 4. Consumer staples. Companies in this sector typically demonstrate greater resilience during market turmoil, though those with significant international operations could face tariff-related challenges. 5. Industrials and materials. These sectors face substantial headwinds from potential disruptions to global supply chains and reduced international trade volumes. Investment implications. For investors navigating this turbulent environment, several strategic considerations emerge. 1. Diversification. The current market environment underscores the importance of diversification across asset classes, sectors, and geographies to mitigate risk. 2. Defensive positioning. Increasing allocation to defensive sectors like utilities, consumer staples, and healthcare could provide relative stability. 3. Quality focus. Companies with strong balance sheets, sustainable competitive advantages, and pricing power are better positioned to weather economic uncertainty. 4. Volatility management. Implementing volatility management strategies, such as options-based hedging or increasing cash allocations, may be prudent given the elevated VIX levels. 5. Selective opportunities. Despite the negative market sentiment, selective opportunities may emerge in oversold quality companies with limited direct exposure to tariffs or trade conflicts. Conclusion. The U.S. stock market is experiencing extraordinary volatility driven by concerns about a potential global trade war following President Trump's sweeping tariff announcements. While a modest rebound in futures on April 8 indicates potential stabilization, significant uncertainties remain regarding the implementation timeline, scope, and international response to these tariffs. Market volatility, VIX, historical and projected. The market outlook depends critically on whether negotiations can moderate the proposed tariffs. Meanwhile, the Federal Reserve faces complex policy decisions in balancing growth concerns against potential inflationary pressures from tariffs. Investors should prepare for continued volatility while maintaining a disciplined, long-term investment approach focused on quality and diversification. As this situation remains highly fluid, market participants should closely monitor developments in trade negotiations, economic indicators, corporate earnings guidance, and Federal Reserve communications for clues about the evolving market trajectory. Thank you for watching. Don't forget to subscribe and share so that the channel can grow and upload more good videos. Thank you again.